Good morning, everyone. Welcome to New York Fed. And first of all, I should apologize about my voice. I'm fighting a cold, so I have a little bit of a weird voice, but hopefully I can talk through the 30 minutes. Probably most of you, whenever you hear the word Fed, you often associate with monetary policy. But in the last few years, you often heard about this terminology of lender of last resort, which is another key and important function of the Fed. And what I plan to do or aim to do in the next 30 minutes is to try to explain what this role is and why it is so important. And to do that, it's useful to go a little bit back and understand what are banks and what's the importance of the interbank market and deposit insurance, and then we'll talk about the lender of last resort. Now, just think for a minute to set the stage. I know that my colleague explained that banks now are much more complicated than this, but just for a second, imagine that we are thinking about banks as those banks that we used to have in the old days, very simple, plain vanilla institutions that raise funding through deposits and use that funding to make loans. Okay, that's very simple. Now, what happens here is that these institutions have very liquid liabilities and very liquid assets. And that combination makes them very fragile for the following reason, that if there are rumors or some information about the banks, what do you think will happen? Well, the depositors will have an incentive to run to the bank and withdraw their money because they know that, well, there is this characteristic of first come, first serve. So the first one in line can withdraw all of its deposits. The second one probably also true, and the third and the fourth. But as the bank is required to sell more and more of its illiquid assets and therefore will have to sell them at a discount, eventually it will run out of money. And of course, the last deposit or the last but one at some point, there will not be any money left to pay those depositors. And so understanding this, of course, if you are a depositor, you don't want to be the last one in line, certainly. Therefore, the incentive to run to the bank. Now, this is not just a theoretical concept. And we have seen many examples. Here is one example in the old days in Chicago of a bank run to this particular bank. Typically, the idea of a run, all the depositors lining up to withdraw their money. But it didn't. And then here's another one. Very recently in the UK, the Northern Rock, which I'm sure many of you are familiar with, what happened there. But it also happened here at home. Here is another one familiar, that where there is a run and all the depositors queuing to withdraw their deposits. Now, at this stage, the question will be, well, why do we care about these runs? Well, we care about them because they can force an institution that is otherwise solvent into bankruptcy. Remember, I said, if there is a rumor which may be valid or not, the depositors have an incentive to run. And then the institution will have to start, because the institution cannot tell the depositors, wait, come back in 6 months or whatever it is to withdraw your money. No, I want my money now because it's a demand deposit. And the institution eventually have to sell its assets. And because it sells at a discount, because they are illiquid, then it runs out of money. So a run can force a failure of an even solvent institution. But worse is that it can propagate and lead to many other failures, because if you see a run on a bank and if your money is on the bank across the street, guess what will happen? You probably may start hearing rumors and concerns, and you have an incentive to run on that institution as well. Or even the first one will withdraw their money from other banks and put pressure on other banks. And so you have this situation where we often say, well, what starts in one institution cascades in a domino fashion and leads to the failures of many other institutions. And that's where it's problematic, because these failures or these banking crises, now we are talking about a large number of failures, can be very costly. Early research on this, and this is very difficult to identify these costs, but early studies have measured these costs at around 6 to 8% of GDP, which is a large number, and more recent ones have done a more careful job, and they come up with numbers as high as 20%. So losing 20% of GDP can be extremely costly for the society. And so that's the first point I would like you to keep in mind in thinking about this role of lender of last resort, is the following, that bank failures, and in particular banking crises, are costly to society. And so if they are costly, well, we need to do something about them to address them, and we certainly don't want to have them often and often. So what is it? One option or one mechanism that exists in most countries, or nearly all of them, is this notion of the interbank market. Why is the interbank market important? Think of the interbank market as a market, as any other market. This one is used by banks where they trade liquidity, usually very short term. At the end of the day, some banks have extra liquidity and others have liquidity shortages, and they lend to each other overnight. So it's very helpful because it moves the liquidity from the places where they are in excess to places where it's in shortage. And also, going back to the story about the run, if a bank is experiencing a liquidity run or a shock, it could use this market to borrow liquidity from other banks to avoid having to sell some of its assets at discount. So if the market were operate efficiently and well all of the time, this would be very useful to protect banks from liquidity shocks. The problem is that sometimes the market breaks down. And it breaks down for some of the same reasons that could trigger, for example, the runs. If banks are uncertain about the financial condition of other banks, what do you think will happen? They will not be willing to lend liquidity to the other bank because they think that, well, even though it's overnight, there is no guarantee that tomorrow the bank will have enough funds to pay me back. So I might as well just hoard my own liquidity. And if I am concerned that I may not be able to meet my liquidity needs in the market tomorrow, rather than lending today, I keep the liquidity for myself. And what that does is that the liquidity does not shift from those who have in excess to those who have lack of liquidity, and the market will break down, and some institutions who are in need of liquidity will not be able to meet their liquidity needs. And there are examples throughout history where this has happened. One case in point, very recently, well, not as recently now, you can think of the LIBOR OIS as the price that banks pay to borrow and lend in the interbank market. And of course, when the price goes up, that's usually a sign of what? That there is too much demand for the supply that there is in the market. And immediately after the Lehman, there is an example where the price just skyrocketed, basically indicating that the market came to a halt. And so institutions who needed liquidity could not meet their liquidity needs in this market. And this brings me to the second point I would like you to retain is that, well, interbank markets are useful and they are certainly helpful in helping banks deal with their liquidity shocks or shortages, but they don't operate smoothly all of the time. There are instances where they will break down and the institutions or the banks will not be able to meet their liquidity needs, and then we are back to the scenario that I described earlier. So how do we complement this? Well, I'm sure all of you, or certainly many of you, are aware of this, because when you go to the bank and choose where to deposit your money, the first thing you probably look at is the bank insured by the FDIC. And most countries have introduced deposit insurance. Deposit insurance is very useful because it protects you from the risk of the bank. What it does basically the following, that if the bank fails, then the deposit insurance will step in and pay your deposits. Now, you see immediately now, going back to the story earlier that I said, well, if you hear a rumor about your bank that you have an incentive to run and withdraw your money, once the bank is insured by deposit insurance, that incentive disappears. Because, you know, look, worst that can happen is that the bank will go bankrupt, but in that case, the deposit insurance will pay my deposit. So there is no need for me to run anymore. And so we don't need to go and withdraw the money from the bank, even if we hear that the bank may be experiencing some difficulties. And in the US, we introduced deposit insurance in 33. And as you can see there, the insurance coverage have been increasing. It used to be 100 until 2008, and right now is $250,000. So as long as you have up to $250,000, pretty much don't care about what happens at the bank. So that's good because it eliminates those incentives to run and go withdraw your money to the bank. Now, it has its own problems. I'll give you one example and then explain why is it that deposit insurance alone doesn't solve the entirety of the problem. Well, one problem, as you can see here, is that because you don't have this pressure to withdraw your money even when the bank is not performing well, you don't act as an institution or as an entity that imposes some discipline on the bank. So the banks now feel free to say, well, we can take more risk because the creditors, in your case, the depositors, will not withdraw their money. And so if they are not priced the right insurance fee for the risk they take, they will have an incentive to take on too much risk. It's the traditional moral hazard problem that comes with insurance. Now, that's a downside of the deposit insurance, but for the purpose of what we care here, which is about the issue of protecting banks from liquidity shocks, deposit insurance will not do the job entirely because of the following. Not all deposits are insured. And in fact, one of the reasons why deposit insurance do not cover all deposits is to reduce that problem of the monitoring, because they want to leave those depositors that have huge deposits, usually more sophisticated deposits, to put some pressure on the banks when they take too much risk. But of course, the downside of this is that banks will have a portion of their deposits that is not insured. And those deposits, they have the same incentive to withdraw whenever they hear there is a problem, because if the bank goes bankrupt, they will lose their money. And indeed, increasingly over the years, that fraction of uninsured deposits has been growing, or at least it has become significant. Here you have the percentage of the assets. On the left-hand side is for the entirety of the banks in the US. On the right-hand side is for the largest ones, the top 10. The blue portion is the insured deposits. So as you can see, most of it is insured deposits, but there is a good number or a good portion that is uninsured, particularly among the large institutions. And those deposits have the same incentives as the ones we discussed in the absence of deposit insurance to withdraw their money whenever there is a problem on the bank, and therefore impose a liquidity shock on the bank. But that's not the only difference. The other difference is that increasingly, and this comes now complicating the bank. So we started with a very simple institution, just plain vanilla deposits with loans. Now we're starting to talk about, well, banks fund themselves with other sources of funding, and it has been growing that others. So here you have the blue, what's now in blue is the total deposits, insured and uninsured, and you have other categories above. The one I would like to call your attention is the one in yellow, which is basically the repo funding, which some of you may have heard. It's very short-term funding. In a very simple way, think of the following, is that the institutions have securities. It can be a bond or other type of security sitting on their balance sheets, and what they do is that they give that bond to another institution for a given period of time, and the other institution gives some money back. At the end of maybe a day or 2 days, they reverse the positions. So the other institution gives back the security, and the borrower gives back the money. So that's called the repo transactions, and it became an important source of funding, but usually very short-term, and of course exposes the institution to liquidity shocks, because if the market stops, or if the other institutions that are doing these transactions suddenly say, I don't want to do it anymore, because, for example, I don't think this security is very valuable, or I have concerns with it, then suddenly the institution that was using that funding finds itself without it. And this is important, as you see here, that has been growing, particularly the largest institutions, and there was indeed an episode of this during the crisis where the institutions that were relying extensively on repo funding suffered a huge shock, because think of this in a very simple way. The haircut index is the following. Suppose you have a security that is worth $100, okay? If everyone agrees on the value, suppose it's a treasury bill, and you want to repo that security, you are bank A and you have the 100 treasury. You give the 100 treasury to bank B with the agreement that at the end of the day, they reverse the position. So they give the security, and the bank B gives you $100 in the morning, and at the end of the day, they reverse. The $100 goes back to bank B, and the security comes back to bank A. Now, in general, because securities are not all of them are treasuries, some have different values and different uncertainty, they apply what it's called a haircut index, which basically, if it's securities, if suppose it's at 20%, if securities you think it's worth 100, you get only $80. Of course, the bigger the haircut, the less money you get. So it's a cost of that transaction. And you can see here, during the crisis, that went up dramatically, meaning that for the same pool of securities that you had, now you can borrow far less money. There was another aspect that is not here, is that many securities that the institutions would use for repo, they decided that they would not be willing to take them anymore because they were concerned with their value. So bottom line is, the institutions that were using repo funding suddenly felt themselves with a shortage of liquidity, and there was a negative liquidity shock. And note, it has nothing to do with deposits, it's coming from a different source of funding. But that's not the only places where, and also note the following, deposit insurance couldn't do anything about this because it's outside the coverage of deposit insurance. But the liquidity shocks can come from other places elsewhere. So we already talked about deposits. We saw here about another form of funding. But it comes from elsewhere. And one in particular that was a big problem during the crisis is these liquidity provisions that banks have provided or given to some arrangements they put in place to do securitization. In a very simple way, one thing that became common for banks to securitize, be mortgage, credit cards, receivables, or other loans, was to put them in vehicles that then would raise funding in the commercial paper market, therefore the terminology of asset-backed commercial paper programs. But to make these programs more appealing to investors, many banks, what they did was to provide a liquidity guarantee to these instruments, basically saying that, look, if the instrument is not, or the vehicle is not able to raise funding in the commercial paper market, which is usually very short term, we, the bank, we will step in and provide funding to the institute, to the vehicle, okay? And so it worked well, it made it attractive for investors, and it functioned well as long as the commercial paper market was working well. But at some point when there was some uncertainty in the market and these vehicles were not able to raise funding anymore in the commercial paper market or renew their funding, they went back to their banks and say, well, now it's time for us to make good on your promise. You need to provide us with the liquidity. And of course, that imposed a huge liquidity demand on the banks. Nothing to do with deposits. In this case, it doesn't even have anything to do with funding. It's just a different activity that the banks have been doing. And again, in line with the story that my colleague was telling earlier in the previous presentation, it's part of this increased complexity of financial institutions. But that's not the only example. There's others, and I'll give two more where these, and again, deposit insurance here was useless for dealing with that problem. Another example, we often think about banks as making loans, but banks also make, by large amounts and increasingly more, what is called credit lines, which is basically like a credit card, but they give to corporations. They basically say, well, you are a corporation, you may need funding in the future, you take out a credit line, it's worth for, say, $100 million for up to 3 years, and that means that over the next 3 years, you can go back to the bank and withdraw on your credit line at your will, okay? Now, what this does is that it's profitable for the banks because the banks make money and revenues out of granting those credit lines, but it also exposes banks to a liquidity risk because these institutions can come back and withdraw on their credit lines. And one thing that we know and we have certainly seen is that during crisis periods, these institutions tend to draw more on their credit lines, but even more so, which is, and that's what is reported here, this is the drawdowns on the top, and the bottom one has the percentage of credit lines that is fully drawn down, as you see, and the vertical bars are the crisis periods we have had in the US. And you see, of course, during crisis periods, they draw down much more, which poses more liquidity on banks. But the other thing which is not here, but we have found, is that that increase tends to accelerate if the bank is experiencing problems. Why? And you can think of that as yourself. If you have a credit card, you may say, look, I have a credit card from a bank, and if the bank is in trouble, I may want to use my credit card because if the bank goes bankrupt, the credit card will become useless. So I may want to withdraw. If I'm planning to use it, I may accelerate that. And that what's going to do is that is going to put pressure on the bank. And we see that the same thing with respect to corporations that have credit lines, and they go and withdraw the money from the banks. Another example where it has nothing to do with funding, deposit insurance couldn't do anything, has to do with another activity that banks do that expose them to the possibility that they will be exposed to this shock. One final example that is even more remote, that is something that can start out completely outside the banks, but it's going to affect the banks because of the way they operate and their complexity. This is one case where I'm sure many of you have heard. This was following the failure of Lehman, when Reserve Primary broke the buck, and this became known. The week after, basically, there was a run on many money market mutual funds, and investors withdrew about $145 billion. At first sight, you may say, well, that's a problem of the money market fund industry. What does this have to do with banks? Well, it has to do with banks because the money markets are huge players in the commercial paper market. They are one of the key investors buying commercial paper issuances. If they stop buying because they have to keep their liquidity to meet the withdrawals of these investors, there is no one buying, then what's going to happen? Those issuers that need to meet their liquidity needs in the commercial paper market won't be able to do it, some of them including the asset-backed commercial paper programs, and in some cases corporations, and if they are not able to meet them in the commercial paper market, guess where they go? They go and withdraw it from the banks. Because, for example, a standard corporation that issues a commercial paper, it often has a backup line of credit from a bank, which is exactly for this purpose, that if it's not able to roll over its commercial paper in the market, it goes and withdraws the money from the bank. So it's a case where it started out in the money market fund business and ended up having this negative impact in terms of liquidity on the banking industry. And so this gives me to the third point I would like you to retain, which is deposit insurance helps, but it still leaves banks exposed to many potential liquidity shocks. And that's where it comes in the role of the lender of last resort, which is exactly last resort. Well, this is something that it started, goes back to 1876 or 67, sorry, to this gentleman, and a couple of one, but he is often associated with being the grandfather of the lender of last resort function, Walter Bagehot, and it was related to a failure of an institution in Great Britain, and at the time he wrote extensively about this function, and he basically proposed the function with many other things, but with 4 key principles that I have it over there. The first one being that the central bank should make clear in advance its readiness to lend freely to institutions. Point number 1. Point number 2, lending should be done only to illiquid but solvent institutions. Point number 3, lending should be done at a penalty rate, being at a rate higher than the market interest rates. Lastly, lending should be done against good collateral. Okay? And since then, most countries in one form or another have adopted this function, and the vast majority or nearly all of them, this function is attributed to the central bank because it's the only institution that is credible in doing it because it can basically print money. But as with any other regulation, and even though it's a couple of 100 years old, it's still the subject of intense debate. And so what I'm going to do next in a couple of slides is to present to you some of the discussions about this function. One is, well, there is indeed one big camp that says, well, it's important and we should have a lender of last resort. But there is another camp that says, well, we don't need a lender of last resort. The markets themselves can take care of banks whenever they have a liquidity need. That's true theoretically under certain circumstances, but we already know that even theoretically there are circumstances where that happens, and we have seen examples where, for example, the interbank market can break down and banks in need of liquidity supply are not able to meet their liquidity needs in the market. So that doesn't, and if there were any doubts, certainly the last crisis have shown that repeatedly. So certainly it's critical, and I think by now the majority of people will accept that we do need a lender of last resort. Of course, there are others that say, well, we understand that the markets may have this problem, but one alternative is we change the way banks operate. Even though theoretically we have reasons to believe, and it's important to combine deposit funding with lending, and because of the ability of banks to provide liquidity and extend loans, others would say, well, let's solve this problem by creating the so-called narrow banks. What's a narrow bank? A narrow bank is an institution that uses deposits but makes only investments in very safe assets. Of course, in that case, the institution has only liquid assets, so the run problem will disappear. But the problem here is that if we were to move into that direction, we would be likely to see the emergence of other institutions that probably were going to inherit the problems that banks have. So at the end, it wouldn't likely solve the problem. So let me just then go on and present a couple of about the story of the debates. For example, one is that Bagehot advocates that central banks should commit to lend freely. It's the idea of committing. Some would say, well, if the central bank commits to lend, the institutions are going to take too much risk because they know that if they need liquidity, they will go to the central bank. That's a fair observation. But on the other hand, if the central bank adopts this policy, what's often called constructive ambiguity, which is denying in some cases liquidity support to some institutions and not to others, what that will do is that the institutions are going to hoard too much liquidity, which is not efficient, and even more so during crisis periods, which is also not efficient. So that will not help the problem, and in general, it's probably better to committing to grant liquidity. The second one is that lending should be done to individual institutions. That's the proposal of Bagehot. And there is a large debate about this because some will say, well, because the central bank will have a hard time distinguishing solvent from insolvent institutions, what that will do is that in some cases it may end up lending to institutions that are insolvent. If the market were the one taking care of this, the market probably would know better and would be able to distinguish. That's an assumption. But there is one more fundamental problem behind that idea that the central bank should only lend to the market and let the market distribute liquidity, is that the market in some cases may not distribute that liquidity to the institutions in need because of uncertainty or concern. So that would not solve the problem, and it would leave institutions exposed to liquidity shocks. The third one is, well, Bagehot advocates that lending should be done at a penalty. The idea is that, well, we don't want the banks to go to the central bank and borrow lots of money and then make money out of that if lending is done at a discount. And in fact, in the US, until '93, the Fed would lend at the market, at a rate below the market. Now it lends at a penalty. There is some truth to that, but there is one important aspect that's often missed in that debate, is that the true cost of borrowing from the central bank is not only the interest rate that the bank pays on the loan. It is also what is often called the stigma, which is, and the banks hate or avoid borrowing to the central bank because if they do it, it becomes known, and the other institutions will infer that the bank is experiencing problems and it probably does not want to deal with it in other dimensions. And so the institutions avoid as much as they can to come to the central bank because of that signal. So the interest rate, while important, is only one metric or one component in the decision to borrow or not borrow from the central bank. The last one is this debate about lending only to illiquid institutions but solvent. That's the proposal by Bagehot, which most central banks do adopt, but it's challenging because distinguishing illiquidity from insolvent in real time, because sometimes these decisions have to be made overnight, it's not an easy job. And Bagehot himself appeared to have recognized these challenges when he wrote back then that every banker knows that if he has to prove his worth of credit, however may be his argument, in fact, his credit is gone. So it's a challenge, but on the other hand, if we push to the other extreme of saying, well, we will lend to any and all institutions, that of course will be a huge source of moral hazard problem because then the institutions will take too much risk. So let me conclude with presenting, since I'm running out of time, as I said, so the Fed has a lender of last resort policy and has been using it since it was implemented in the 30s. Let me present the importance of this policy in 3 episodes so that you can see the role it plays in practice. One is, the first episode is immediately after the Fed was established. It was in 1914. In the years that followed, there were no bankruptcies or no banking panics in the US. But from 1929 to 1933, there were many panics in different parts of the country. And as a result, back then, granted, many of these were very small banks and so forth, so there was many number of banks in the country, but still, back then, the country lost about 40% of the banks. It's a huge number and huge costs for the economy. Now, and there is many debates about that, and the whole thing stopped only when the FDIC was introduced in 1934. And there are many studies about the way the Fed acted back then, and it's often agreed in many claims and with some good evidence that if the Fed had acted according to the Badger Doctrine, probably we would have not experienced that same depth of crisis or that same number of failures, and probably we would not need the deposit insurance, at least at the time, to stop it. Certainly would have likely have helped in terms of limiting the effects of the crisis. The second episode, which the Fed acted very differently, was on the 9/11. Immediately after the 9/11, even though, no, this is an attack, everyone knew that had nothing to do about affecting the banks. But what happened is that it affected the payment systems, and as a result, some banks were not able to shift payments to other banks, and others because of concerns, decided to start hoarding liquidity. As a result, concerns emerged that liquidity was not flowing in the interbank market, and what the Fed did very quickly was to come out with this statement that the Federal Reserve System is open and operating, this discount window is available to meet liquidity needs. And immediately after that, the Fed loaned about $45 billion to different financial institutions that needed the liquidity, and by the end of September, things went back to normal. So had the Fed not acted that actively and quickly, we probably would have seen a credit crunch or certainly bigger effects than what we had seen. Of course, the last one is what the Fed did during the most recent crisis. And again, here, in contrast to what it had done in the early 30s, but more in line with what it did in the 9/11, very early on, the Fed started acting very actively and introducing measures to deal with the liquidity shortages that banks and other financial institutions were dealing with. And one of them was by extending funding through the discount window. Another one was to introduce facilities to allow banks and non-bank financial institutions to borrow at a longer term, because the funding through the discount window is usually very short term. One of them is the TAF. And as you can see, by the volume of borrowing that happened during that period from the Fed, you can see how important this was. So the dark part at the bottom is, you can think of it as the traditional discount window lending, very short term. The other one is the one done through TAF, which is usually a longer term, 28 days initially, and then a longer maturity later on. But it increased dramatically, which means how much pressure these banks were experiencing in terms of liquidity. But that's not all what the Fed did. Partly as a result of the innovation and the transformation in the financial system, the Fed had also to create other facilities to deal with liquidity problems that were emerging outside the banking sector. And one case, or two cases in particular, is specifically with the commercial paper market and the asset-backed securitization market, where the Fed recognized the importance of those markets and the liquidity pressures they were under, and it created facilities to help the institutions that were key players in those markets to meet their liquidity needs. And that's the end of my conclusion. So by saying that the presence of a last resort, the letter of last resort that stands ready to lend to solvent institutions in need of liquidity support, is critical for the stability of the financial system. Thank you very much.